The troubles for Meta platform just won't end, with the EU now looking to fine the company up to $11.8 billion for new anti-competitive charges. And while a lot of these fines for tech companies are fair and justifiable, in this case, the reasoning behind this potentially gigantic fine is pretty ridiculous. Today, I'm going to break down the details of this fine and what it means for Meta platforms. Also, we are near the end of the financial year for a lot of regions around the world, so it's a good time to get your stock portfolio in order, ready for tax time. And a great way that you can do that is by using today's sponsor, which is SHARESIGHT. And I'll talk a little bit more about what SHARESIGHT is and the best deal that you can get a little bit later in this video. Meta platforms, which of course used to be Facebook, has been one of those businesses that just can't be left alone by regulators all around the world. I mean, you had the Irish Data Protection Commission, which fined them $900 million this year, and that same commission fined them about $250 million last year. So they continually seem to want to fine or find reasons to fine Facebook. Oh, and let's not forget about the $5 billion fine for Cambridge Analytica in 2019. And of course, I'm not saying that all of these fines are unjustifiable. I mean, if you just look at the Cambridge Analytica one, it's completely reasonable that that was a massive fine because the consequences of Facebook's mismanagement through that problem was significant for a lot of people, millions of people in fact. But it's also no secret that governments love to look for any way that they can get money out of large corporations, and it's particularly the case with businesses like Facebook and Google, which operate globally in many countries around the world, most countries around the world, but don't pay corporate tax in most countries because they're able to use tax loopholes to move their revenue into particular areas, whether it's their Singapore subsidiary or whether it's their Irish subsidiary, where they're able to access the lowest global corporate tax rates, whichever country that's in. And essentially that leaves a lot of governments around the world feeling as though it's not fair that businesses like Meta are able to operate and provide services for many customers, whether they're individuals using Facebook or businesses advertising on Facebook. Many countries believe it's unfair that Facebook can operate and generate so much revenue from these regions, but the country themselves doesn't actually get anything back from them. Maybe they have more jobs that Facebook hires in those areas, but besides that, there's no direct kind of tax being paid by these businesses in these countries. And a lot of the time it leads them to look for laws and ways for them to get money out of these businesses. And one of the best ways for governments to get money out of Meta and Google is to use anti-competitive laws or antitrust laws, which are often very vague and can be interpreted in a wide variety of ways. And this time it is the European Union that is laying down the law on Meta platforms. The European Union on Monday issued Facebook's parent company, Meta, with a list of objections over its online classified business, Facebook Marketplace. Facebook Marketplace, if you don't already know, is exactly what it sounds like. It's an online marketplace. People list secondhand clothing and furniture and games and consoles and computers and golf clubs, all kinds of different things. And essentially using Facebook's already existing massive messenger ecosystem, it's really easy for people to negotiate with sellers through Facebook Messenger and to organize whether the item will be delivered or picked up, or whether you want to look at the condition of it. It's super easy. You can just organically message the sellers right in Facebook Messenger, which for most people is where you communicate with most of your friends and family. And a lot of the time people will just pay with cash when they're doing these transactions with between buyers and sellers. But Facebook also offers the opportunity to transact payments. They offer their payments infrastructure, which is massive and very secure, and people can do payment transactions through there. And Facebook actually doesn't take a cut from these transactions at all. So unlike businesses like eBay, which are able to take a cut through these transactions, Facebook takes nothing. They just charge the processing fees, and that's it. In fact, Apple makes more money from Facebook Marketplace because if you sell things through the app on Apple devices, Apple, of course, loves to take their cheeky 30% commission. But essentially, Facebook hasn't been in this marketplace business as long as many of major competing businesses and apps and that sort of thing. But they were able to quickly assert market dominance because of the other features that Facebook has. They already have this massive messenger and user base ecosystem that makes it almost immediately probably the best place to search for things in, a marketplace style website. Unfortunately, it's some of those additional features which has got EU regulators concerned about its business and whether it's anti-competitive. According to CNBC, the European Commission, the EU's executive arm, said that it found Meta breached EU antitrust rules by distorting competition in the markets for online classified ads. The Commission took issue with Meta's pairing of the Facebook Marketplace service, which lets users list items for sale, with its personal social network, Facebook. It said it was concerned that this arrangement gives Facebook Marketplace a substantial distribution advantage that competitors can't match. Margaret Vestager, the Commission's vice president in charge of competitive policy, said the tie-up of Facebook with Marketplace gives users, quote, no choice but to have access to Facebook Marketplace. So if I understand this correctly, the reason why Facebook is anti-competitive is simply that their service is better than competition. Call me old-fashioned, but I thought antitrust laws were there to protect consumers from businesses that stifle competition, that actively engage in behavior that prevents customers from seeing competitive offers or accessing competitive offers. Facebook has done none of those things. Facebook isn't preventing you in any way or hiding the fact that you can go to many other marketplace apps. It's just a fact that it's more convenient to do so where you already communicate with your network, with your friends and family. Makes it a lot easier to, mesh those things together. I mean, let's really think about that last statement. Marketplace gives users no choice but to have access to Facebook Marketplace. So essentially, because most people already use Facebook, it's anti-competitive for them to offer their existing customer base another service. To me, that makes absolutely no sense. I mean, it's kind of like if you said that Apple Music was anti-competitive because by just having an iPhone, you automatically have access to Apple Music. That doesn't mean that Apple Music or Apple is stifling competition. You can download Spotify or a bunch of other music distribution apps. I think it's kind of ridiculous to suggest that just because a business has a large customer base, that every service they offer automatically or for free to their customer base is stifling competition. And I know people love to jump on big corporations, especially Facebook, for the wrong things that they do and the anti-competitive behavior that they do actually engage in. And I'm with people on that. I'm certainly no, Zuckerberg fanboy or Meta Platforms fanboy. I have my issues with Facebook, but this right here is actually ridiculous. And even more ridiculous, if the Commission can find enough evidence to support their initial claims, they can fine Facebook up to 10% of their global revenue, which would be about $12 billion. To put that in perspective, that is 40% of their net profit. So their net profit would be taking a 40% hit if they were hit with this fine. Or if they decided to pay it out of the cash that's on their balance sheet, they would be taking a 30% hit to their cash and cash equivalents. Plus, that fine would absolutely dwarf any antitrust fine that has ever been handed down. I think the largest was one that went to Google that was about 4 billion euros, so a little bit more than that in US dollars. But this would obviously smash that out of the park. And to be clear, Facebook hasn't been handed down this fine yet. This is just them starting to talk publicly about pursuing Facebook in regards to their marketplace. But considering that Facebook's spokespersons said that they don't believe they've done anything wrong when it comes to marketplace, I think we will see the EU continue to collect evidence over the next year or so maybe. And then I think we'll definitely hear more about a fine coming down sometime next year or the year after. I also want to talk about how this fits into our investing. I'm sure a lot of people are curious how I think about businesses that are constantly getting faced with regulatory scrutiny or new regulations or fines being handed down. How does that fit into our ability to invest confidently into businesses over time? The first thing to say is that these fines are impossible to predict. There's no use trying to, it's fun to learn about these fines and how they're unfolding, but I'm not looking at this particular case and then trying to come up with a prediction as to whether the EU will actually fine Facebook. I have no idea whether they will, when they will, or if they do, how much the fine will actually be. So we need to deal with it in some other way. And there's really three ways you can deal with regulatory scrutiny or fines when it comes to the value investing process. The first way to think about it is when it comes to the risk factors in the business. So whenever we're looking at a company, we want to assess some of the potential risks that may completely derail the investment. And when it comes to regulatory scrutiny, every business faces regulatory scrutiny, but there are certain industries or certain markets or certain businesses that are positioned to face a lot of scrutiny going forward. And if a business is expected to continue to face regular scrutiny, or it's an industry that's maybe new and what the regulations for that industry will be is fairly uncertain, then it may mean that we can't invest confidently in that business. At the end of the day, we need to be able to be confident that the business will be thriving in the future and that we can come up with a reasonable projection of future cash flows. And regulations and fines and that sort of thing could be one of the reasons why we're unable to invest confidently. But assuming we can invest confidently, there's really two ways we can deal with it in our valuation. The first way is to subtract a regular amount from our future profit projections and our annual future profit projections to account for the fact that the business is likely to be fined every now and then. So in Meta Platforms' case, maybe we subtract 2 to 3 billion from their profit figure in our projections every year, and that can account for the fact that every 2 or 3 years they have essentially experienced a $3 to $6 billion fine. The other way that we can deal with it is a way that we deal with every business's uncertainties, and that's margin of safety. So we never want to invest in companies at fair value or at intrinsic value. We always want to be buying businesses at least 50% or around 50% below their estimated fair value, and that margin of safety allows for not only errors in our valuation, mistakes that we make, but also things that happen that we couldn't foresee, and one of those things is regulatory scrutiny and fines. When it comes to Meta Platforms, I don't invest in Meta Platforms currently. I did previously, but the reason I sold it wasn't primarily in relation to regulatory scrutiny, although it might have played a minor role in my ultimate decision, because the truth of the matter is that Facebook and Google, as incredible businesses as they may be in other aspects, they are at the forefront of a lot of governments' minds in terms of potentially restrictions on how ads can be placed in the future to protect consumers, and then just these regular fines that seem to just pop out from either the EU or a particular European country or the US or Australia. There's almost always something going on in regards to governments and how they're regulating these businesses. And that does provide a significant amount of uncertainty for these businesses going forward. And really, at the end of the day, it's up to the individual who's investing in the company to look at the facts and make a judgment as to whether you think that those uncertainties are too large, that there's no price that you could pay that could overcome those risks. Remember, you don't need to make a judgment about every single business you invest in. You only really need to have a strong opinion about the ones that you do invest in. And that's ultimately where I sit with Meta Platforms. I don't have a particularly strong opinion either way as to whether regulatory scrutiny will make them a bad business in the future. I really don't know. I don't know either way, and it doesn't bother me because it's not a business in my portfolio. If they do well over time, that's great. If they don't, that's great. None of them will impact my return. What businesses are in my portfolio will impact my return, and that's where my focus is. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Unlike data provided by most brokers, SHARESIGHT considers the impact of capital gains, dividends, brokerage fees, and currency fluctuations when calculating returns, which gives you a complete picture of your portfolio's performance. SHARESIGHT tracks shares and ETFs across 40 different stock exchanges, 100 currencies, commodities, and even cryptocurrencies and unlisted investments such as private equity. Plus, SHARESIGHT makes tax time a breeze by giving you a simple but comprehensive view of your capital gains and dividend income impact. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription.